Apple recently announced their new user interface, which is called Liquid Glass. I think it looks kind of okay. I think it's not too important. The main focus of Apple is, of course, Apple Intelligence. We are in the middle of the AI boom, so they have to get this right. This is Apple's AI initiative to use cloud-based AI to make the experience on the iPhone much better. What's really interesting to me is that many of these big companies, like Apple, Google, and Microsoft, used to be a monopoly in their own field. Apple was making phones, Google was doing ads, and Microsoft was licensing software. But suddenly, they are competitors right now because they're all competing to get the most market share in AI. Apple stock is trading right now at around $200. But the question is, should you buy or should you sell? Let's find out in this video. Let's first talk about the economic mode of Apple. Does it have a strong economic mode? Is it protected against competition? Does it have a strong network effect? Is there a high switching cost? Let's find out. With this economic mode analyzer, it's based on Warren Buffett's framework. He was the first one who talked about an economic mode, which basically refers to a mode in a castle from many years ago. And if it's a strong mode, then it's protected and the castle is protected. Let's type in Apple and we can analyze. And we can see it's a white mode company, which is great. And the overall score is a 9 out of 10. So let's have a look at the strength and risks. The strength, world's most valuable brand. iOS ecosystem creates high switching cost. Once you are locked in into their ecosystem, if you have a MacBook, an iPhone, it's hard to switch because everything integrates well. So if you have another device, it will not work properly. It's annoying. So people stick with an iPhone. They have premium pricing power. They have economies of scale because they are such a large company. Massive scale in hardware production. And the risks. What are the risks? Dependence on iPhone for majority of the revenue. Increasing regulatory scrutiny and potential saturation in smartphone market, which is a big one, I think. Potential saturation in smartphone market. Because right now, smartphones, I think personally that they kind of have reached a peak when it comes to performance. You need a good battery, you need a good screen, and you need a good camera, and it needs to run fast. And phones these days, they kind of do that all thing. So to make improvements, it's very, very hard to do right now. Here we can see the latest income statement of Apple. We can see that over 50% is iPhone sales. We talked about this risk that they're very dependent on iPhone sales and that the demand for phones can go lower because they have basically peaked based on performance. So it's hard to innovate on this segment. And we can see that. So you might say 50%, that's not too much. But however, if we look at the Mac and iPad and wearables, you can see that if you add everything up, it's over 75% is still hardware and 25% is services because they know that they have to diversify their income streams. So we can see that the net income is $93 billion, 24%. That's pretty good. That's the money that's left in pocket after. The only problem with Apple is they're borrowing a lot of money. Here you can see the debt to cash ratio. And this for some investors this might be a concerning thing. Now we're going to find out what the true value of Apple actually is. I filled in this intrinsic value calculator, I filled in all the numbers. And it's based on Warren Buffett's formula for owner's earnings. They use this earnings for every year, the owner's earnings, which is basically left for stockholders. And then they put it, and then you discount all the future owner earnings for every year to present value. And that's your intrinsic value. You discount it, of course, with a discount rate. And the formula is net income plus depreciation and amortization plus other non-cash items minus maintenance capital expenditure. So you fill everything in. And this one is really important because this is like how much you expect the company to grow. I looked on these different sources and I came onto an average of around 10%. I think that's realistic for the next 5 years. And then after that, it will halve. It will only be 5% a year. And we use a discount rate of 8% because it's a high-tech stock. So let's calculate the intrinsic value. We can see that it's overvalued by 27.86% based on this calculator. The intrinsic value is $2.3 trillion. And it's significantly lower than the $3 trillion it's right now. We come over a true value of $157 per share. And here you can see the 20-year discounted cash flow projection. We can see here the Apple charts. We are now on weekly candles. We are now looking at weekly candles. And we can see it's trading right now at $201. The white line is the 200 simple moving average, and the blue line is the 50. So the 200 and the 50 blue moving average. Well, if we look at here at the patterns and at the lines, it's in a strong uptrend on weekly candles. And this is a very typical look of a great company. That's just a reason also why Warren Buffett invests in it. It's in a strong uptrend, like it's a fundamental strong company. That's why it looks like this. But the question is it cheap? Well, we calculated and it was 157.16, so it's not cheap right now. And that's why you should not go all in on Apple at the moment. I think it's not a bargain right now. But I think the probability is still slightly higher that we will go up because the trend is still intact on the weekly candles. However, if you go back to the daily candles, we see that here was a death cross, and now it's trying to break the 50 simple moving average. But there's still, I would say it's a coin flip whether we go down or up. So yeah, I think you could buy right now a little bit, and then wait until it's around the true value per share. I will wait until it will be around the true value per share. Does that mean that it will go there? No, absolutely not. Apple can fly up, but only buy a stock if there's a really high risk reward to it. And I don't think that Apple will have a high risk reward. I think it will grow over time because I think they still have a strong economic mode, what we talked about, a 9 out of 10. So I think it will go. I don't think the growth will be extreme, so I will not go like all in right now. Maybe a small position and then average in when it drops lower. And if it goes up, that's so be it. There are many other great stocks we can invest in. I hope you enjoyed this video. Always do your own research, keep your cash reserve, and see you in the next video.